Hello, friends. A very good day to all of you, and I hope you're all doing fine. Over the next few minutes, we discuss some of the key events of the recent past related to the Indian equity market and also present our views on the market outlook. The Indian equity market performed well during the previous month. While the large cap segment during the month was mildly positive, the mid and small cap segments outperformed significantly. The defense sector was the standout outperformer, especially in the latter half of the month, post the pause in Operation Sindoor. FIIs continued to be buyers of Indian equities for the second consecutive month, with monthly inflows outstripping the previous month's flows. Domestic institutional flows moderated a bit, but were still strong at over 3.5 billion US dollars. Increased investor interest in Indian equities and improved sentiments were visible as there were initial signs of improved interest in IPOs and block deals in the secondary market after the several months of lull in activity. The earnings season is coming close to an end. The earnings delivery has been broadly in line with expectations, which were quite muted in the first place. Large cap basket has delivered muted earnings growth on a year-on-year basis, and small cap segment has witnessed earnings decline, while mid caps have fared relatively better. Despite the slowdown witnessed during financial year 2025 on the earnings front, the expectations for financial year 2026 continue to be in mid-teens for large caps and even higher for mid and small caps. On the valuation front, with the sharp upmove in the market in the past few weeks, the valuations once again have moved above long-term averages for all the categories. However, on a relative basis, large caps continue to offer relatively better valuation comfort over that of mid and small caps. In this backdrop, delivery of earnings going forward becomes even more crucial, especially for mid and small caps, to sustain current valuations. As far as our portfolios are concerned, we continue to focus on economic recovery plays and consistent compounders that have room for higher than average market earnings growth, as well as possible valuation re-rating. Our focus continues to be to invest in high quality and well-governed companies available at reasonable valuations. Our portfolios, by and large, have focused on domestic businesses as against exporters and global dependent companies, given greater comfort on domestic growth and continuing lack of clarity on tariff situation and global growth. The key risks to watch out are both global and domestic. On the global front, we would watch out for policy changes in the US, both fiscal and monetary, including tariff-related measures which could impact global growth dynamics. On the domestic front, apart from the policy-related measures, the key factor to watch out for would be the delivery of corporate earnings in the coming quarters. On investing in equities now, we believe that one needs to follow time-tested principles of regular investing and long-term focus. With expectations of continued volatility in the short term, we advise equity investors to make disciplined and regular investments with long-term focus and utilize periods of volatility to build on long-term portfolio at better valuations. We advise investors to have a slight tilt towards large caps and look at mid and small cap strategies only from an overall cycle perspective and have an investment horizon of at least 3 to 5 years. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.